Let's start with a bit of economic history. In the 1980s, it used to be said that the higher a company's turnover, the better its performance. Competition boiled down to a battle of the titans. From the 80s onwards, there was a move towards considering that the bottom line was the measure of performance. In other words, the profit for the period as shown in the income statement in relation to turnover. Companies were expected to deliver a net profit margin of at least 10%. It was not until the early 90s that the captains of industry became obsessed with the new concepts of return on capital employed, comparing operating income to the operating resources needed to produce this income. In other words, net fixed assets and the working capital requirement. A rate of 12% to 13% is generally expected by shareholders. But try not to be blinded by this. Trying to achieve the highest ratio at any cost can, in extreme circumstances, lead to suicidal management that only focuses on the short term and neglects the long term. If a company stops investing and reduces its stock levels, it will no doubt improve its ratio, but this approach will also sound the death knell for the business. It is not always easy to measure a company's performance, in particular because the concept of performance is difficult to pin down. One way to get an approximate idea is to evaluate the company's level of activity. The level of activity is initially analyzed by looking at its development. Is the business in a phase of expansion, stagnation, or contraction? These movements may be directly linked to the life cycle of the company and of its products. Are they in a phase of launch, development, maturity, or decline? Having an overall picture of the company is not enough. We also have to compare it to other companies in its business sector. For example, although a company may be in an expansion phase, it may actually be losing market share if its growth is weaker than that of its competitors.
3 elements are fundamental when measuring a company's operating activity. Turnover or revenue. This comprises sales of goods for resale for trading companies and production sold for manufacturing and service companies. These items are found in the income statement, where they are shown excluding VAT. Total production. This is equal to turnover plus or minus changes in stock levels plus capitalized production. Note that capitalized production is production manufactured by the company for its own use. Finally, value added. This equals total production minus consumption of supplies from third parties. These are primarily general and administrative expenses or overheads, subcontracting costs, and temporary staff costs.
It is worthwhile analyzing the percentage that value added represents in relation to revenues. In other words, in comparison to sales for a trading company and to annual production sold for manufacturing and service companies.
The value of this ratio depends on the type of activity. It is low in trading companies such as supermarkets, for example, and high in knowledge-based businesses such as consultancy firms. The positioning of the company within its industry. The more use a manufacturing company makes of subcontractors, the lower its value added.
Note that if we want to understand the development of a company's performance, we need to look at the changes in its activity from one year to the next. But we should be aware that a company's activity may increase without a corresponding improvement in its performance.
Let's take the example of a company in which revenues have increased by 5%. First possibility. If prices have increased by 10% over the same period, then the increase in revenues corresponds to a drop in activity by volume. Second possibility. If companies in the same sector have recorded an average increase of 10% in their revenues, then an increase of 5% corresponds to a drop in relative market share.
So, it is the changes in activity levels rather than the activity levels themselves that indicate improved performance. In addition to these activity indicators, calculated using the company's financial data, we can also analyze physical activity indicators. So, we could analyse the number of cars produced by an automotive company or the number of subscribers for a mobile phone operator. However, if the physical activity indicators increase, is this necessarily the same thing as an improvement in performance? Let's take the example of two cars, a sports car and a normal car. Both can go at 200 kilometers an hour over a given distance. Does that mean they both have the same performance?